So I don't know if we've seen the lows in gold, but I know for sure we haven't seen the highs. So when this correction is over, the price of gold is going much, much higher. So the Fed is not going to pull the rug out from under this bubble, but it has to pretend that if it ever sees an inflation problem, that it's got the tools to fight it, even though it's bluffing, because even if it had the tools, it would never use them because the tools would destroy the house of cards that they've erected.
Peter Schiff, manager of the Euro-Pacific Fund, manages about $1 billion in assets for his clients and is known to be a strong supporter of gold. On March 10th, in an interview, he explained that the two safe havens par excellence, gold and US bonds, will move in opposite directions in the future. According to him, gold is bound to rise while US bonds are bound to, at best, stagnate and more likely to fall. And indeed, in 2020, the world made a grim discovery. US government bonds have not played their role as a safe haven asset as well as the world used to in these times of economic recession. Since 2020, on 3 occasions, US bonds have fallen along with stocks. These are the green periods on the chart. As for gold, it has performed well since it is up about 15% over 1 year, but since August 2020, it has shown signs of weakness. So the question is, what will be the safe haven for the next decade to protect our portfolios? If we understand correctly, US bonds are in danger because of the large amounts of money injected into the markets. But what is the outlook for gold? Come on, let's go. Basically, Peter Schiff tells us that gold will be the safe haven par excellence in the years to come. To understand what a safe haven asset is, I suggest that you make the connection between what we call a safe haven and the concept of anti-fragility discovered by Nassim Nicholas Taleb. By definition, a safe haven asset rises when markets fall. As for anti-fragility, it reflects the ability of an asset to rise when market volatility increases. Making the connection between anti-fragility and safe haven is like making a link between falling markets and high volatility. If we look at the VIX index, which is an index of volatility on the US equity index, the SP 500, all the major equity market crises have occurred in the context of rising volatility. Here we can see the Asian crisis of 1998. In 2000, the internet bubble burst and took over. Then volatility resurfaced in 2008 with the subprime crisis. Finally, the euro crisis took over before ending with the crisis of the anti-COVID measures in 2020. So there is clearly a link between volatility and financial crisis. Dieter Darcet, who does economic and financial research for Gavekell Intelligence Software, has an explanation for this link. He explains that in normal times, when the market is calm, each player makes decisions independently of the other players. Of course, they watch TV and read the press, but the general opinion represents a minority influence in investment decisions. It is essentially his personal reflection that defines his decision-making. In this case, we speak of the wisdom of crowds, in the sense of James Surowiecki's book. This author demonstrates through numerous experiments that a crowd in which each member makes decisions independently of the general opinion makes better decisions than the experts. In this configuration of events, markets tend to rise because market efficiency plays its role. It is on this hypothesis that all of Markowitz's modern portfolio theory is built. It is in the state of the masses that we can see a normal distribution of events. It is from this observation that the famous VAR method for value at risk, which makes it possible to evaluate the risk according to the Gaussian bell curve, is derived. According to this risk assessment model, big financial crashes are extremely rare. However, reality has shown us that these events, which in theory should only occur every 1,000 years, happen every 10 years, so there is a problem in the theory. At this point, Didier Dawson explains that in the event of an imminent economic or financial crisis, market players start to get scared, and to protect themselves, they copy each other more and more. The market is no longer in a configuration of wisdom of crowds, but a madness of crowds because everyone runs in the same direction to reach the exit door. At this point, Didier Dawson explains that the laws governing the market change because the market itself changes in nature. In normal times, opinions are decorrelated, while in times of panic, they become more and more correlated, and this is quite understandable. In a movie theater, if someone yells fire, you're better off running for the exit than trying to see where the fire is and risk dying from the fire. This is why volatility is equated with fear. It is no coincidence that the laws of the market change. In these periods of market turmoil, Markowitz's theory of rational agents no longer applies. One must resort to behavioral psychology models to understand them. Moreover, once we understand that volatility is above normal about 20% of the time, then we can expect dramatic crashes quite regularly. Until 2020, gold and US bonds were the safe havens in these market panics. From my point of view, US bonds had the merit of intelligence, while gold is a guarantee against stupidity. US bonds had value in times of crisis because the US economy was the strongest and a dollar was the best currency. That is why short-term US bonds were a safe bet. I say that they had the merit of intelligence because bonds are a monetary tool built by the intelligence of man. Gold, on the other hand, is stupid. The value of gold is based on a 5,000-year-old historical belief that this yellow metal has value. So in normal times, when mankind is able to develop a well-managed currency, gold goes back into the shadows because we have a more sophisticated monetary technology. But when we no longer have good currencies because humanity is doing anything with them, then, intuitively, humans throw themselves back on gold, which represents the smallest common consensus when our societies no longer have confidence in their elites. That's why Peter Schiff, who has been noticing the deterioration of value of the dollar for years, is shouting from the rooftops that gold will rise. And so far, over the last 20 years, he's been totally right. So are we doomed to fall back on gold until a new, strong currency emerges? In my opinion, yes. Today we don't have anything better in the pipeline. If you think about Bitcoin, I think it may be safe to have monetary technology that we can rely on in the future. But today, it is still a speculative asset that does not have that place for the financial markets. But then, why has gold been falling since August 2020 while the different US administrations keep printing dollars at the drop of a hat? Charles Gave, president of Gave-Kell Research, a company that manages $2 billion and advises about 1,000 institutional investors around the world, offers a clue. It is possible that China has understood the role of gold and the future evolution of the dollar, and that it has decided, without saying so, to index its bonds to the price of gold to demonstrate that the yuan is a strong currency. No official statements, at least for the moment, but actions. If this hypothesis is correct, then the Chinese government is regulating the relative price of the yuan against gold. This implies that China would have much more gold than the official 2,000 tons, which is an assumption that will surprise no one the day China reveals its true gold stocks. If these two assumptions about China's gold holdings and its willingness to price its bonds in gold are true, then this would explain why there is a reversion to the average value of Chinese bonds in gold. So if the price of gold is down right now, it may be because the price has risen a little too high relative to Chinese bonds. What does this mean? First conclusion, in my opinion, the price of gold will go back up and we are at interesting prices to buy gold. Second conclusion, it reinforces my view that Chinese bonds will be the second pillar of safe havens in the next 10 years. The slow and structural decline in Chinese interest rates is a very good configuration to ensure this role because the price of bonds evolve in the opposite direction of interest rates. Third conclusion, as explained by Lewis and Charles Gave, with Didier Darcet in an article dated March 10th, Chinese bonds are beginning to attract the attention of foreign investors since we are seeing a movement of foreign capital towards Chinese bonds. So even if Peter Schiff misses the Chinese bond game, I think his gold bet is still the right one. On that note, see you soon for new videos. Ciao!
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.